Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Double trouble. Markets brace for volatility from the latest CPI data and a Fed decision coming less than 6 hours apart. The White House weighs more chip limits to China while ramping up Russian sanctions to include semiconductors. And Oracle extended gains after better than expected earnings and partnership deals with Microsoft and OpenAI. 3.5 hours until Act 1 of the big play today. It is CPI that gets released. 0.3% is what we're expecting on core. 6 hours later, Jerome Powell takes center stage. S&P 500 futures easily extending to new highs yesterday. Not too much action this morning as we await the data. It was thanks to Apple. Apple finally at $3 trillion. Yet again, a big old rally yesterday, the best since 2022 after their AI announcement, their partnership with OpenAI. There kind of seems to be a theme here. Oracle announced a similar partnership yesterday that also helped their shares pre-market this morning. U.S. 10-year yields little change. We're at 4.4%. It was a rally yesterday, perhaps concerns about what's happening in Europe, but also a strong bond auction. Are the auctions okay? Are we fine with more supply just as long as inflation is behaving itself? Euro, that's also a little move this morning. 107 is where we stand. Perhaps the most interesting market continues to be the French bond market. Bonds getting pummeled. The spread between France and Germany, 62 basis points. Bruno Le Maire, the French finance minister, is warning of a Liz Truss moment if Le Pen emerges victorious. What does that mean for the ECB? Are we talking about a de facto easing because of politics? Again, poor Liz Truss, always being used as the example for what you want to avoid. So it is that double dose of economic news we're bracing this morning. Both CPI and a Fed decision are coming out today. Again, 3.5 hours is when we get CPI. We are on edge this morning, even though markets are a little changed. Let's get now to Bloomberg MLive reporter Noor Al-Ali. Noor, set it up for us. What are we expecting?
Good morning, Danny. Well, it all comes down to that core CPI reading, and what it will say will really dictate how markets view the Fed. I mean, reminder, the FOMC meeting is underway, and the Fed's data dependence makes it really, being held hostage by those monthly readings. And so if we do see that CPI reading, particularly on the core front, confirming that it is in fact easing and not a blip from what we've seen in the last month after those really hot and sticky prints in the first few months of the year, then that should set up the Fed for a dovish, at least take that markets will take, and then carry that rallying that we've seen in treasuries on the back of that really good 10-year auction that we saw yesterday. So incredibly exciting, especially also into the BOJ meeting on Friday, where the yen then will become on focus. So a lot for markets to factor in just into the weekend, Danny.
Yeah, Noor, thank you for bringing up the BOJ. I know today's exciting, but we can't forget them on Friday. Noor Al-Ali there from the Bloomberg team. Noor talked about the excitement of today. Here's someone who's throwing some cold water on it. Paul Donovan of UBS, writing in his morning's note that economists are overstimulated by the U.S. today. We have the excitement of U.S. CPI, a Fed decision, and that Fed Chair Powell's press conference can be relied upon to dampen economists' passions. The Fed is unlikely to change policy, and the fabled dot plots of policy projection will add confusion. A black mark on a chart gives no sense of confidence or risk. Well, lucky for us, we don't have an economist today. We have a voice of reason. It is Bhanu Baweja, chief strategist at UBS. Bhanu, there you go. Paul Donovan saying other economists, they're too overstimulated on today's data. What do you think? Are we hyping it up too much? How much does it really matter? The double dose of CPI and Powell.
Well, look, it does matter, right? Because, I mean, if today the Fed changes their dots from 3 to 1, they effectively shut out the possibility of rate cuts all the way potentially till December, right? So you have a rate cut that they will not do in July or in September or in November, and then we have to wait all the way till December, because again, November meeting comes just 2 days after the presidential election result, and it's going to be quite hard at that time to move on rates. So it does matter. However, I will say this, right? We are expecting a fairly benign report for CPI. Which, as you call, was the Act 1. So we're expecting 24 basis points on core, which is below consensus. Consensus is around 29 to 30 basis points in core. And while we don't really speak about the headline, this time actually the headline could be quite important as well, because we're expecting 8 basis points in headline. Only 8 basis points. This is, of course, month-on-month data. And the reason we're expecting such a benign number is, of course, because gasoline prices are coming off. And on core, we're expecting vehicle insurance prices and OER. These are the two components of CPI that have been very hot for some time. OER, for the first time, is going to drop below 40 basis points in about 3 years. And that we think the Fed is going to have that information Tuesday night before they would have made the decision today. So we think this is going to mean, on balance, that we get 2 cuts this year in terms of the median dots, and that will be consequential. But if we get 1 cut, I think we can forget about rate cuts all the way till December. What does this mean for markets? Well, we do think that the 2-year still has extremely good risk reward to receive. At about 485, the markets completely ignored the previous CPI print. If the Fed is not hiking, and we don't think they are hiking anymore, at 485, 490, we think it's very good risk reward, regardless of today's decisions, to actually receive the 2-year.
Yeah, it's something that PIMCO has called a generational shift, considering where we are with higher rates. Bhanu, a lot to unpick there. Let's just tease out that point a bit, because the flattener trade, much like this being the year of the bond market, hasn't really played out. It is a front end that's been scared of the Fed, and it is a long end that's been concerned about the economy. So are you saying this is a flattener trade, or do you expect that the 10-year yield also will be coming down precipitously with the 2-year yield?
Danny, it's a steepener trade, right? Because
yes,
we think the 2-year is going to we think the 2-year is going to do more than the 10-year. But to your point, the 10-year is also going to come down. The 10-year is about 440. We think we can get about a 20 to 25 basis points decline in yields at the 10-year by the end of this year. But on the 2-year, you could potentially see about a 75 basis points decline in yield. So while the curve is sort of inverted in nearly 40 basis points to stand, you can see by the end of this year that we can see the curve becoming absolutely flat. And then into next year, the curve becomes steeper. Many people have been worried about the curve bear steepening. I mean, there's a little bit of technical jargon basically saying that the 10-year is going to sell off. And as a result of that, the curve is going to steepen because of fiscal worries and so on. And while fiscal worries are relevant, well, we think inflation or the cycle is the bigger driver. And as inflation comes down, the decline in the 2-year is going to dominate. And in fact, the gravity of the 2-year is also going to pull the 10-year lower. Less than the 2-year will move, but nonetheless, the 10-year will also come lower. And therefore, we think bond positions are fairly attractive at these levels. We would agree with PIMCO that these are good levels to buy bonds. I say that just ahead of the CPI report, and it's quite a risky time to do that. However, I do think that even if the CPI report isn't as benign as we expect, at these levels on the 2-year, and given what's priced in for real rates today until infinity, basically all the way in the forward space, real rates are above 2%.
Well, Bhanu, I'll tell you why it's not as risky this time. If you look at the stats over the past 2 years, 88% of the time, 10-year yields have fallen after a Powell press conference. 2-year yields have dropped 76% of the time. That's a trend that's persisted this year. Presumably it is because Powell has this dovish bias that every time he talks, he turns around markets because he has this proclivity in order to cut. He wants to see those cuts. So how much can you really predict the moves of today? Saying that, you know, inflation will come in a certain number is one thing, but actually knowing how this market reacts is a completely different thing, Bhanu.
That is true. I mean, but I think we really have to ask ourselves one salient question. Can the Fed hike from here? Now, there was some discussion in the recent FOMC minutes that that's a possibility. But as you said, Powell has actually ruled it out in his own comments. I mean, he doesn't seem to think that monetary policy needs to get any more restrictive. Remember, the unemployment rate is at 4, Naira is at 4.1. So you're within touching distance of the unemployment rate relative to equilibrium. Core PC is not a million miles from 2.5%. So soon you're going to have inflation settings and unemployment settings which are actually close to equilibrium neutral, whereas policy is nowhere close to neutral. Policy is very restrictive, 2%, 2.25% real rates. And that's why the Fed doesn't think that even if we get higher inflation here, that we need actually tighter monetary policy. They will just keep monetary policy restrictive. If that's the case, then the 2-year can't rise more than 5, maximum 510. We are trading 485 to 590, and therefore the risk reward is you lose 20 basis points, potentially for 75 to 80 basis points gain, which I think is a very strong risk reward in the 2-year.
Okay, Bhanu, you're going to stick around with us. Bhanu Baweja of UBS. Let's first get some the top stories trending on the terminal this morning. The UK's economic recovery has stalled in the run-up to the general election. GDP was flat in April compared with the previous month. Economists had, though, expected a 0.1% drop in output. It is a setback, though, for Prime Minister Rishi Sunak, who had been campaigning on evidence that the economy is turning a corner. Meanwhile, in China, consumer prices rose less than expected in May. Factory prices dropped as well for the 20th month in a row. The still weak prices have fueled calls for more government action to shore up demand. BlackRock CEO Larry Fink and Microsoft CEO Satya Nadella are among business leaders headed to Italy to participate in the G7 summit this week. Bloomberg has learned that the executives were co-hosted by President Biden and Italian Prime Minister Giorgia Meloni to support a push to invest in developing countries. We also just got a line from the G7. The G7 has called on China to stop enabling Russia's war machine in Ukraine. Speaking of which, Biden, anticipating this, has been looking to put the squeeze on Putin's access to semiconductors via China. We'll have the details for you. And then later in this hour, we're going to catch up with Citi's Veronica on why the bar for cuts is lower than the market assumes. That's all to come on Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. So the G7 is gathering in Italy. They've issued their first statement, a statement saying that China essentially needs to stop supporting the Russian war machine. Now, to that point, in anticipation of the G7, the U.S. is widening sanctions on the sale of semiconductors and other goods to Russia. It's targeting third-party sellers in China and elsewhere as it looks to squeeze Putin's war machine in Ukraine. Hours before we learned that, we also learned that the U.S. is weighing more sanctions on China specifically, not sanctions, rather, limits on China's access to chips that are used to build AI. Let's bring in Rebecca Chung-Wilkins, our reporter in Hong Kong. Rebecca, clearly the U.S. sees that they have a strong lever here, that they can really pull chips when it comes to being hawkish with China and at the same time trying to limit what Russia is able to do. The question is, how wide are these and how effective are they?
Yeah, absolutely. In some ways, this sort of, fills the circle of U.S. foreign policy, both on the one hand, trying to limit strategic technologies and access to that from China, but also trying to squeeze and pressure China more to help and do more when it comes to restricting Russia's own access to what it says are, shipments related to its war machinery, particularly with this focus on chips. Now, these widened restrictions that you mentioned that will also include, for example, identifying by address entities that the US alleged have been linked to and involved in these reshipments of chips to Russia. So really the latest set of sanctions are about trying to move away from goods that are just in US origin, but all of the things that are happening along that supply chain and these sort of so-called reshipments and rerouted goods. Now, the US repeatedly has expressed some amount of frustration. It's asked Beijing repeatedly to do more. And, in some ways that reflects the difficulties in their position here. It is worth pointing out, however, that trade between Russia and China, or exports rather from China into Russia, fell by about 14% so far this year. And we've also had this sort of drop-off, a reported drop-off in the number of Chinese banks that will allow Russian entities to move money. So we have seen some responses on the Chinese side that perhaps this sort of threat of repercussions is actually rippling through.
Rebecca, quickly here, because we're almost out of time. There's also more tariffs, more restrictions coming from Brussels, this time on Chinese EVs. We've been waiting to see what Brussels' response will be. They're likely to announce a 25% tariff. What does that mean for China in a market that has a lot of overcapacity and had planned on putting much of that into Europe?
Well, in short, would really be a blow, particularly if we see it on the higher end, 25% or anything higher, really above than 20. This is arguably China's most important export market for EVs. And EVs are absolutely critical to what China calls the 3 new drivers of growth that are intended to underpin the new model and the new generators of growth as we see property in decline.
Okay, Rebecca, thank you very much. Bloomberg's Rebecca Chung-Wilkins. Okay, I want to get a quick check on Oracle this morning. One of the big stocks moving in the pre-market, up some 9% this morning. It had reported that bookings beat expectations, and it also announced a partnership deal with some of its biggest tech rivals. OpenAI was one of the words ushered in that. There seems to be a theme here, not just Oracle jumping on an OpenAI partnership, but at the same time, Apple, $3 trillion. Let's get back to Bhanu Baweja of UBS. Bhanu, I know you write that equity markets are running ahead of their drivers. Either drivers need to change or tactical correction is likely. We'll get into that in just a moment, but one of the drivers clearly here is AI. One could even argue OpenAI and partnerships. How much longer does that driver have to run?
You know, we're not chasing sort of the Magnificent Seven within that, because we think that the AI narrative, strong as it is, has probably run a little bit ahead of itself. This is not to say that broader tech can't do well, but particularly the AI narrative. And again, you know, this is relevant for the medium term, but we are skeptical that we are in the midst of a productivity boom right now, right? I mean, quite the contrary, where you see in the US, consumer demand is slowing down. The overall economy is slowing down and employment is extremely strong. That actually speaks to weaker productivity, not stronger productivity. So at this minute, we're not chasing the Magnificent Seven. We're not chasing so much the AI theme. At the same time, because life's never simple, at the same time, we have lower real interest rates penciled in because we have lower inflation penciled in, and lower real interest rates do help technology. So we do like the broad technology sector, and we are long in China, we're long in Korea, we're long in Taiwan, we're long in parts of Europe in technology, also in parts of the US, but we're not necessarily chasing just the AI theme, which is something that we have been on for some time. But at this minute, we're taking a step off in not chasing NVIDIA very aggressively at these levels, and broadly for Magnificent Seven as well. It's quite nuanced. It's not a buy situation. Not a
buy situation. What needs to change? What sort of drivers need to change to get you excited about this U.S. equity market? Because you say either that or there's going to be a tactical correction. Just from hearing what you're saying, Bhanu, with the slowing of productivity, it sounds like you're more towards the tactical correction camp.
Well, I do think that first you're going to get help for the market arriving from the fundamentals in the form of lower rates. We spoke about lower inflation. We spoke about lower rates. I think that will help the market first before weaker growth creates enough headwinds that the market comes down. So in the near term, over the next month or two, as we get bond markets rallying, that's dependent on inflation rates coming lower as we expect. Again, 24 basis points today on core inflation below consensus. And that should mean that the 2-year rates, there's not a lot of debate on 2024. The debate is in 2025, where, you know, we think the Fed is going to cut much more aggressively than the markets are priced for. And that should mean the 2-year rates come down now. And that should help the market. It should help utilities. It should help consumer discretionary stocks. It should help tech. But beyond that, there are very clear signs that the U.S. consumer is tiring. So that fatigue of the U.S. consumer will mean over the medium term that earnings expectations will probably be found out to be too high, and that's when the market corrects. So interest rates help first, growth hinders second.
Right, and you like European and Japanese consumer stocks over U.S. consumer stocks. Bhanu, I mean, if we had talked about this a couple months ago before this earnings season, I would have said you're crazy. The U.S. consumer keeps buying. But the earnings season did show some weakness in names like Starbucks, Walmart, people trading down. When does it get from these slight cracks in some of these earnings reports to something actually bad, something actually that points to either economic weakness or even recession for the consumer? And just less than a minute here, Bhanu.
Yeah, look, I mean, let's define bad. There is no balance sheet problem, okay? There, however, is an income statement problem. Real disposable income in the U.S. is growing close to zero, and the markets are paying attention. Consumer discretionary stocks in the U.S. have underperformed staples through the course of this year, and that's what we're hearing also from all the bottom-up indicators, Nike, Walmart, Dollar Tree, and Dollar General. All of them are telling us that the U.S. consumer is fatiguing. Europe, Japan, the other way around.
Okay, Bhanu, thank you so much. We really appreciate your time this morning. Bhanu Baweja of UBS. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some of your front page news, a look at what's making headlines around the world. First up, Washington Post leads with this. President Biden saying that he will respect the judicial process and he will not be pardoning his son Hunter, who yesterday was convicted in Delaware of violating federal gun laws. In that, a jury had found that Hunter was addicted to drugs when he bought a gun in 2018 and had lied about it in order to get that gun. He becomes the first son of a sitting president to be convicted of a felony. He also faces a criminal trial on tax charges. That will happen just 2 months before the presidential election. Next up, we have this. Elon Musk has dropped a lawsuit alleging that OpenAI and its CEO Sam Altman breached a founding promise last year. Musk didn't provide a reason why. Finally, let's get to Paramount. This is leading on the Wall Street Journal that Sherry Redstone has ended discussions to sell her controlling stake in Paramount to Skydance and merge the two companies. It's been months of drama, of negotiations. It's been one of the messiest deals to play out in recent years. Okay, coming up, we get back to the drama of today, CPI and a Fed with Veronica Clark. From our global headquarters in New York, I'm Danny Berger. Manus Cranny is out on assignment and also probably on a beach somewhere. Let's set your agenda. It is double trouble. Markets are bracing for volatility from the latest CPI data and a Fed decision. They come less than 6 hours apart. The White House weighs more chip limits to China while ramping up Russian sanctions to include semiconductors. And Oracle extends gains after better than expected earnings and partnership deals with both Microsoft and OpenAI. It is the OpenAI effect on this market. Oracle gaining nearly 9%. Apple yesterday back at a market cap of $3 trillion. All of that was enough to lift us up to a new record. S&P 500 futures up 0.1%. But in 3.5 hours, you get the first act of the show. It is CPI. Then 6 hours later, Jerome Powell takes center stage. For now, yields little change. We are under 4.4%. A rally yesterday led by maybe the concerns in Europe, maybe a strong auction. Speaking of concerns in Europe, euro little change this morning, stronger by 0.1. 107 is where we stand versus the dollar. It is French bonds that have sold off dramatically. 62 basis points is the gap with Germany, the widest in quite some time, the widest since October of 2023. So again, it is concerns over the French election. Emmanuel Macron is speaking right now. We'll bring you any lines that come from that. In the meantime, we need to focus on the event of today. The events, I should say. And on that, Veronica Clark, U.S. economist at Citi, writes that the U.S. labor market is loosening while inflation is set to come in cooler, and the Fed is willing to cut if either of these trends become more pronounced. We continue to think the bar for cuts is lower than the market is assuming, particularly if the unemployment rate continues to rise. She joins us on set now. Veronica, thank you so much for joining.
Thank you for having me on this busy day.
Yes, a very busy day. So thank you for coming in on the busy day. Yeah. So, okay, assuming that we get somewhat of a benign inflation report this morning, are you expecting to hear a Powell that is really championing cuts to come?
I don't know if he's going to, guide towards cuts at a coming meeting necessarily, but I do think he's going to leave all options on the table. I don't think he's going to rule out a cut as soon as July, which I don't think anyone is expecting that. We are now expecting the first cut in September. But I think he is going to sound more concerned on the labor market than maybe people are assuming. Obviously, we had a very strong payroll job growth on Friday, but I don't think the Fed is going to love that the unemployment rate is gradually ticking higher and is now at their year-end forecast. I think that's going to be a concerning sign for them.
I mean, but there's been thoughts out there, maybe the unemployment rate is higher because of different factors like immigration, things like that, but just the jobs number in itself is strong enough. So what do you say to those folks?
Yeah, there has been this very strange divergence between the two surveys of employment that we have, the payroll survey and then the household survey that determines the unemployment rate. The truth is maybe somewhere in the middle. There is this idea that maybe it's strong immigration that's showing up and boosting those payroll, very strong payrolls figures. And it does seem, after we had that 272 on Friday, it's probably unlikely that we're going to get a sharp enough slowing in the one print before July that the Fed will be cutting in July. But I do think the ratio of unemployed to labor force in that household survey, there's no real reason to believe that even if the levels are mismeasured in that survey, that the ratio is wrong. So I do think they're going to be concerned that unemployment rate's ticking up.
Okay, so we might hear Powell say that, which I think would be a change for this market and maybe awaken some animal spirits. It is clear that it is a Powell who has a bias towards cutting. The question is whether the rest of the FOMC, share that proclivity, because you have heard the Neil Kashkaris of the world come out and be much more hawkish than Powell. So even if he wants to cut, starting in September and then cut from there on out, can you get the backing from the rest of the members?
Yeah, I mean, it will come down to inflation data, of course, also, and we've heard from some of the more hawkish members like Governor Waller, need to see several months of inflation data. That's probably more than the 2 that we're going to get before July, so today and 1 more. But I think that's somewhere around 3 or 4 months. And I think we will see things like shelter inflation that are slowing. And I think one common factor among Fed officials is going to be that if you do see a nonlinear weakening in the labor market, they will react to that. And we are maybe on the precipice of that now. I think this is a labor market that the Fed will still describe as in better balance, looks a lot more like 2019, but you are verging on the border of an uncomfortable weakening.
That's really interesting. I mean, when do you really see that manifesting itself, if it's just, again, a little bit uncomfortable right now?
Yeah, I mean, it can happen pretty quickly. What we know about the labor market right now is that businesses have definitely slowed hiring, pulled back hiring. Hiring rates are at 10-year lows. You see that in survey data. You see hours worked declining. You see part-time employment increasing. To us, that feels like every step to cut labor costs other than laying people off. But we have had a pullback in spending in the last couple months. We hear that in the consumer equity earnings calls, retail sales that have been softer. If revenues start to pull back now, maybe you need to do that more extreme labor cutting cost and lay people off. And when that starts to happen, that is that nonlinear weakening of the labor market, and these things can build on each other pretty quickly.
Does it get bad enough that we start talking about a recession again?
Yeah, no, absolutely. I mean, that is the scenario. We in the 80-year history of the unemployment rate, if you go back, full 80 years, the increase that we've had in the unemployment rate over the last year, we've only seen that 13 other times, and 12 of them were recessions.
Okay, so that is a shift, right? Because people have been talking about a soft landing. Does that mean you're not in the soft landing camp?
We are not in the soft landing camp.
Yeah.
We are penciling in this, much more abrupt softening of the labor market, a couple quarters of negative GDP growth, further pullback in consumption and investment. We are penciling in a recession.
I mean, Veronica, it is very different than what's out there right now. I was just looking at Deutsche Bank, which just revised their 2025 assumption for what the dots will be, and it basically saying, actually, the dots will be 25 basis points higher, that there will be 25 basis points less of cuts than we were expecting because of the data coming out. What does 2025 look to you in this scenario where you do see growth starting to decline?
Yeah, we have the Fed cutting every meeting after they start cutting. So there's obviously a lot of uncertainty around when that actual start is going to be. But I think the labor market backdrop at that point is going to be enough that the Fed's cutting every meeting. So that for us in our forecast is 125 basis points total for 2025.
Right.
75 for this year, so 200 basis points total. Getting back to something that looks a little bit more neutral. But even then, in a recession, you would maybe expect the Fed to be cutting even more, but you'll have the issue where there is still this stickiness to inflation still.
You're not saying stagflation?
No, not stagflation. No. I mean, you will maybe have a period that looks a little stagflationary because the normal cycle should be that rates go up and demand slows, activity slows, and then with a lag, inflation slows. And so I think that's what will happen. Something closer to 2% for sure, 2.3. But are we going back to a nice steady 2% in the long run? That looks a little bit unlikely right now.
I wonder what the danger is in that, because we have a Fed right now who, as they say, are data dependent and they're reacting to every single data point. If there is continuously this lag where the economy is starting to turn, but at the same time inflation at least appears to be sticky, is that right for a policy error, that the Fed doesn't act as quickly as perhaps they should?
Yeah, I mean, I think they'll be measured in how quickly they're cutting rates. This is a not a recession where the Fed has to cut to zero, I don't think.
Right.
So it will be maybe slower than people are used to in the past recent recessions. Quick cutting to zero is probably unlikely. But 25 a meeting is reasonable, I think.
Does fiscal policy make a difference to you, depending who's on in the White House?
Yeah, I mean, certainly in the near term, fiscal policy has been a really important driver of activity. I think that's a real important reason why this lag of monetary policy is taking longer to work its way out into the economy. We've had very supportive fiscal policy over the last couple years, and that looks to be peaking for this year at least. And then, as we're getting into post-election 2025, obviously a lot of uncertainty around what policies will actually be, but it does seem like fiscal will remain pretty stimulative.
Okay, Veronica, it's great to talk to you, not just because it's contrarian, but you have a clear view of 2025, which I think a lot of folks are struggling with. So it is refreshing. Veronica Clark there of Citi. Okay, coming up, keep your friends close, but your enemies closer. Oracle signs a partnership with some rivals, including Microsoft and OpenAI. We're going to have more on that for you next here on Bloomberg Brief. It's your Bloomberg Brief. Danny Berger here in New York. Paramount shares, let's get a check on them, declining in the pre-market trade this morning, down 2.25%. Its chair, Sherry Redstone, has dropped her bid to merge her family's media company with Skydance. For more, let's bring in Bloomberg's Kimberly Adams. I mean, Kimberly, this has been so much drama. Of course this is how it ends. Of course they just dropped the bid completely. How did these discussions break down?
First, there was a meeting that was supposed to take place. Then all of a sudden, Sherry said, the deal's off the plate. We're not going to talk to them anymore. Now, we know this is happening now, and it's a shocker because for months she pushed this deal. She said that the deal with this company would be good for the company and her family, and that this company, Skydance, would maintain her company's, her family's legacy. And here we are right now, and it's nowhere. She all of a sudden said no. A lot of it has to do with the fact that she had a lot of pressure coming for her from the owners, not the owners, excuse me. She had a lot of pressure coming from the shareholders and other managers in the company. They just did not want this deal at all.
Yeah, they didn't want this deal. They said, look, it favors you so much. You get all this sweetened terms. What do we get?
Right.
And there had been other deals. There had been other proposed deals, I should say. Apollo, Sony, people saying, look, maybe we can do it better. Is that what's next for Paramount, or is this a Sherry Redstone who just simply doesn't want to give up control?
Well, what's going to happen now, Sherry Redstone, she has decided that she's going to pursue the sale. It all balanced out with National Amusements. She's going to sell that alone. It'll be better for her to decide to sell Paramount by itself or to merge with another company without this National Amusements. So right now she's got 5 suitors that are interested. We know there's Sony. We know that there's Edgar Brofman. We also know that there's Apollo Global Management that has always been there. Apollo really wants this deal, and Apollo would have proposed a $26 billion deal, and that offer was a little bit more than what Skydance was willing to pay. But that deal proposes a couple of tough regulatory scrutiny issues here.
Okay.
Because they're a foreign entity.
Yes, yes. Kimberly, thank you so much. I'm sure there'll be more drama to come. I doubt this is over.
This should be a movie.
It should be a movie.
Edie Falco should play Sherry Redstone. I thought about this.
Kimberly, I see a future for you as a casting agent. Whenever you want to give this whole thing
Call
up.
me Hollywood.
Kimberly Adams, thank you so much on the soon-to-Hollywood drama of Sherry Redstone and Paramount. Okay, let's get to some breaking lines. The EU, we know that the G7 meeting is happening now. The EU is going to be imposing additional tariffs on EV imports from China. We had been expecting this, but we have finally gotten the news. Our reporting had suggested that it would be a 25% tariff. However, the current headline coming in now, they will be imposing a 17.4% tariff on BYD specifically. That is BYD EV imports from China. So this is additional EV imports coming from China. So again, our reporting said 25%. This one specifically on BYD is 17.4%. Let's get more on this story. Let's bring in Bloomberg's Rebecca Chung-Wilkins, who is in Hong Kong. So, Rebecca, we're starting to get these headlines rolling in. We're starting to hear the actual figures that Europe is planning on doing when it comes to tariffs and EVs from China. 17.4%, a 20 tariff on Geely EV imports from China. Again, these numbers are all around 20%. They are slowly trickling in this morning. What difference does it make? How big of a blow is this to China? And do they need to respond? Will there be retaliation?
Well, just for context here, that standard baseline is around 10%. We were thinking or wondering if we could see something on the higher end, 25 to 30. So 20% might in itself be something that's a little bit or seen a little bit more modest. But certainly any kind of tariff is going to be a blow to Beijing. The EV sector is one of the fundamental parts of how Beijing is remodeling its economy. It's one of the so-called the new three drivers of growth that are in some ways intended to make up that shortfall from the property decline that we've seen really continue to hit and continue to hurt the Chinese economy for years now. So certainly as a blow, the EU is arguably the most important EV export market for China. There are ways that it can possibly get around. So we have seen, for example, this promise of a BYD factory in Hungary. We know there's another Chery factory going to be placed in Spain. And that is one way, for example, where Chinese companies can go into Europe, access the European Union directly, create jobs on the ground, help the local economy. We might see some sort of response in that sort of way as well. Remains to be seen, I think, if we see a tit for tat. Li Qiang, President Xi Jinping, the Chinese officials have made a big effort here trying to sell the European Union and individual European nations on this idea that they want to keep trade lines open. And the sort of punitive sort of retaliatory measures that we've seen so far have actually been relatively modest when it comes to the EU.
Okay, Rebecca, thank you very much. Bloomberg's Rebecca Chung-Wilkins. Just to recap the lines we've gotten from the EU, they will be imposing additional tariffs if you're just joining us now. The figures are this: 17.4% tariff on BYD, 20% tariff on Geely, and a 38.1% tariff on SAIC. They will also impose a 21% average duty on cooperating beverage producers in China. So this is also extending beyond just EVs. This is also looking at BEV producers in China. So BEV rather than beverage, BEV producers in China. So this is a wider EV target. And again, the numbers here are ranging from 17.4% to 38.1%. Let's get now to the earnings front. Oracle shares up some 8%, a little bit more than that this morning. Better than expected quarterly results and a partnership announcement with Microsoft and OpenAI. Let's get to our tech equities reporter. It's Subrat Patnaik, who joins us now. Here we have an Oracle, Subrat, that's partnering with some of its enemies, perhaps, some of its rivals, but it is this OpenAI partnership, we saw it with Apple yesterday, that gets the market excited. What does a partnership exactly look like?
So it's an interesting way of putting it. They're really getting close to some of their biggest rivals because to grow big tech businesses, big tech has been doing business with fellow big tech players like Amazon, Microsoft, and OpenAI is the newest kid on the block, and anybody kind of trying to do an alliance with OpenAI see the shares kind of spiking. So we have seen strong bookings, which is a very small business for Oracle, but investors are all eyes for anything AI right now, and the shares are set to open at a record high after the results yesterday.
And those partnerships, I mean, they obviously only cover a small part of Oracle's total sales. And even though that's what the market was excited about, what did the rest of their results look like? Because we have seen other cloud providers, other software providers start to struggle this earnings season.
Honestly, the rest of their business was pretty mixed. We didn't see a strong bottom line or top line, but investors are clearly very interested in this side of the business that they see as the future. And in terms of getting into AI, Oracle still seems like a very cheap bet with a PE of just about 19 times forward earnings compared to like an NVIDIA, which sits at like 40 times, or even the NASDAQ 100. So yeah, that's definitely what the investors were looking for, and they got that.
Okay, Subrat, thank you so much. That is Subrat Patnaik. Thank you so much for joining us on Oracle. Okay, coming up, we're going to get you ready for the busy Double Risk Wednesday that awaits you in about 3 hours' time. This is Bloomberg. watching Bloomberg Brief. I'm Danny Berger in New York. Manis is off for the rest of the week. All right, let's get you set up for the day today. I mean, you know what today brings, but first, President Biden is going to be heading to Italy later this morning for the G7 summit. That starts on Thursday. They've already condoned China's support of Russia. Then it's the two main events. The first one, 8:30 a.m., U.S. CPI, and then we have a Fed decision at 2 p.m., followed by Chair Powell's news conference. Mike McKee is down in Washington for us to help set up the busy day. Mike, just break it down. What are we expecting?
Well, we're expecting CPI to ease a little bit, but not a lot. The question is how much and what does it take to impress the Fed? Fed officials have been saying they need a couple of months of progress. At this point, this would be 0.1% in the core, lower on a year-over-year basis, and maybe that is kind of what they want to see. But it's going to be all about maybe how far we go out on 3 digits in the CPI rate, because for some of these categories, it's only going to take a very small change to make it either go up or down. But watch rents. Rents and OER are going to be the big issue for the CPI. After that, we get the dot plot. The dot plot thickens. It'll take 6 people to change their dots to get down to 1. It would only take 1 person to get down to 2 dots. And the betting is on Wall Street, we get 2 dots, but no word on timing. That might come a little bit later when Jay Powell gets up and talks to the press. We'll see if he sounds dovish or hawkish, gives us any kind of time frame. But there's a lot for traders to watch today.
I mean, Mike, just quickly here, obviously they're likely to have had the CPI numbers to put that into their consideration. Armed with the strong jobs data on Friday, we're just talking to Citi, who said actually it's not as strong when you look at the unemployment rate. But how does the recent data we've gotten color this decision?
Well, it keeps the Fed wary and takes early moves off the table because they're going to want to see, as they say, more data. Earlier in the year, Jay Powell said maybe we can have a strong labor market and declining inflation. Obviously, the folks at Citi don't necessarily agree. So we'll have to see which one of them is right. Okay,
Mike, appreciate it. We'll let you go. Get some coffee, gear up for your busy day. Mike McKee in D.C. for us. Let's recap some of these headlines we're getting from the EU. If you are just joining us, the EU will be imposing additional tariffs on EV imports from China. Let's break down some of the numbers because they vary depending on who you are. 17.4% tariff if you are BYD. Geely gets a 20% tariff. SAIC will be getting the highest tariff, 38.1%. Overall, if you are a what they call cooperating battery EV producer in China, you will get a 21% average duty. For those who are non-cooperating, presumably this is SAIC, you get that 38.1% tariff. Now, Tesla may also be getting an individual China import duty rate under the EU tariffs. China basically imports all of its Model 3 sedans that it sells in Europe for China, for context here. So they're importing a lot from China to get Teslas in there, but they may be getting their individual import duty rate under the EU tariff. So again, these tariffs range from 17% to 38%, depending on whether or not the EU deems you cooperating or not. The big question for this will be, is it enough for Germany? There's still a huge overcapacity of EVs that BYD itself says that it wants to be the top seller in Europe. Is a 20% tariff enough to discourage folks from buying a very cheap Chinese EV? Germany will certainly hope it is so. Okay, we'll follow that. Plus, get ready for CPI less than 3 hours away, followed by Jerome Powell on the main stage.